Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. This is Monday, the 13th of February. I'm Daniel Lam, your host for the podcast. The upcoming Valentine's Day, as it appears, is probably going to be a blue Valentine for me because it's crashing with my weekly tournament chess night. Well, as you can imagine, my wife is not so happy about this. But for many investors out there, this Valentine's Day could be blue or red, dependent upon the outcome of the release of the US CPI inflation figure, which will come out on the same day. Now, the stronger than expected non-farm payroll report earlier this month set off a chain reaction across financial markets, including a repricing of FOMC rate hike expectations, a reversal of risky asset prices, and an increase in cross-asset volatility. Perhaps most importantly, US rate cut expectations have been reduced. So said differently, expectations for the terminal Fed fund target rate have been pushed up and further out, with markets now implying a peak of nearly 5.2% in July this year. Hence, the upcoming US CPI release on Valentine's Day is taking on added significance. It needs to meet consensus expectations of a further decline in inflation, or markets could fall further. The more the FOMC is compelled to extend the rate hiking cycle and postpone rate cuts, the more likely it is that the US will experience a hard landing, requiring more aggressive rate cuts later. So US rate cuts could still be very aggressive once they come, but they will also start from a high level. So that means the next CPI report has become binary. Markets will either breathe a sign of relief or risk aversion will accelerate. Now, looking at the technicals, S&P 500 index towards the end of last week broke the key support level at 4,100 on Thursday, and it failed to recover that level on Friday. So that's very significant to us. As a result, we would trim any overweight allocations in US and Euro area equities. And equity investors may consider rotating into Hong Kong and China equities, particularly if the Hang Seng Index reaches key support level that we've been highlighting, which are 20,300 and 19,300. And of course, more broadly, we would be rebalancing out from equities to income assets. Now, for those looking for better entry levels, the next key resistance level for the US 10-year yield is basically 3.9%. So Asian dollar bonds remains our preferred area in bonds as spreads continue to tighten as China growth improves. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.